on the way home getting ready to go to church, but I wanted to drop in here really quickly to tap in. The stock market is dropping right now, and I know that there are a lot of investors, beginners, and experts who may be concerned about how to proceed in the current market that we're working in. Like, I'm tapping in from my car because this is an urgent message. There's a certain way that you should approach the market when the market is dropping. Here's a hint. The answer is not to be afraid and to sell. Today, well, I say today because today is Sunday, but I am doing a free class today. I do it on Sundays and Thursdays, and what we are discussing is how to invest when the market is down. How to invest when the market is down. We're going to talk about the strategy that you should follow. The link to register for this free class is in the description of this video. Here's the thing that I need you all to understand. If you liked a stock at a high price, let's say that was Nvidia. If you liked Nvidia at $200, and now we're watching Nvidia drop to $160, just as an example. Well, if you like the company at $200, you should love it at $160. But that's not how people approach the stock market. See, they like the stock when it's expensive, and when the stock starts to drop, they start to worry like, oh, like maybe it's not as good as I thought it was. Maybe there's something wrong with the company. And it's weird because as consumers, we don't approach any other thing with that logic. If we're in the market for an iPhone, okay, and we go into Apple and the iPhone is $1,000, but for some reason next month the iPhone drops to 750, we don't look at that iPhone sideways. We don't look at that iPhone and say, oh, like something's wrong with the iPhone now, it's dropped to 750. No, what we do is we go ahead and we buy that iPhone at 750, and then we probably call a friend or a family member and we say, hey, Apple has the iPhone for $750. This is a great deal. We need to buy it. That same approach that we take when we're buying a product is the same approach that we should take when we're buying a stock. If you go to the grocery store and a loaf of bread is $3, and then one day you go in and that loaf of bread is $1.50, you don't be like, oh, I think I'm gonna buy me another brand of bread. You don't do that. You be like, you know what? I'm gonna buy me 2 loaves of bread. That's how we should approach the stock market when it's dropping. Okay. Here's the other thing that I want you all to understand. And look, I'm going to dive deeper into all of this in our free class. I'm recording this video on a Sunday, so I'm going to say today, but I do the free class on Sundays and Thursdays. So regardless of when you're watching this video, just know the next Thursday or the next Sunday, I'm going to do the free class again. All right. But here's the deal. We're going to dive into the details of all of this in the free class today. So find the link in the description so you can register, so you can be a part of that conversation. But I want to provide some context. Okay. The market does drop. It doesn't always go higher and higher. There are moments when we get corrections. A correction is when the stock market drops 10%. There are moments when the stock market becomes a bear market. So a bear market is when prices are dropping. A bull market is when prices are going up. We get bear markets. Okay. Here's the thing that you need to know. Bear markets typically only last 8 to 10 months. Bull markets, they last about 2.5 years. So even in a moment where the market is down, that's a much shorter period of time that you're going to be down before it comes back. So you just got to be patient. You want to be strategic. You still want to be investing. You want to invest consistently anyway, right? Y'all hear me talk about dollar cost averaging. You're buying when prices are high and when they're low. When prices are low, you're able to buy more shares than you would be able to buy when prices are high. If you really want to get strategic about it, when prices drop, increase the amount that your dollar cost averaging. Because look, Meta isn't a worse company because the stock price has dropped. Netflix isn't a worse company because the prices dropped. The S&P 500 isn't a less quality investment because the prices are dropping. We just go through times where the market needs relief, investor sentiment is different, there are environmental or economic conditions that are changing the values in the market. All of these things happen. But look, y'all, they don't have anything to do with me and you. Okay? We want to be consistent with the stocks that we have identified as being good investments. One of the things that we're going to talk about today during the class, so make sure you register, is we're going to talk about creating an opportunity list. An opportunity list, this is your list of your favorite stocks, ideally 3 to 5. These are the stocks that you always want to buy. You want to be focused. People have, when I do these free classes, people often ask, how many stocks should I own? And I get that because if you're following me on YouTube, if you've seen me on the Anthony O'Neill show, like we're talking about different stocks consistently. And I can imagine, especially for a beginner, it can be overwhelming trying to keep up with all of the stocks that we talk about. But here's the thing, the objective isn't to own all of the stocks. The reason why we share with you investment ideas is so you never have a moment where you're like, oh man, I don't know where to put my money. So we're giving them to you consistently. But the other reason why we're giving them to you, I had to check how fast I was going, y'all. These tickets be adding up. But the other reason why we give them to you is so you can have them on your opportunity list. So when you have money that's available to invest and you get really, really good market conditions, which means you're getting good prices, which means prices are probably dropping, you can go to that list, have it prioritized by the companies that you think are the best investments for you, and then that's what you buy. So that you're always prepared to deploy your money in the market. You're always prepared to invest your money and you know what to invest it in. So you never find yourself at a moment where you're unsure about what you need to be doing because you have a playbook ready. You have that ready already. So we're going to talk about that today on the class as well. So make sure that you are on, whether you get on the free class that's today or the one on Thursday. We're going to be talking about this for a while because I think we're going to see prices continue to go lower. I do think that we've hit our highest points. Um, normally the fall, normally during the fall, the market does decline, but we pushed higher a little bit longer than that I expected. I didn't expect us to get to Thanksgiving and we still hadn't got a major dip. We're getting the dip now, and I don't think that there's enough happening economically for this trend to change. This is just my opinion, and I could be wrong, and I don't care if I'm wrong or not in terms of what I expect to happen in the market, because regardless, I continue to invest. So even if I say, hey, I think the market is going to go lower, I'm going to keep buying, right? I'm going to get better value. Eventually, the market will turn around. Now, if I'm wrong and the market, this is just a temporary dip, and then the market pushes higher, well, guess what? My money is invested. So I'm benefiting that way as well. When you are a consistent investor, when you're investing when the market is high, when the market is low, when you have your opportunity list of stocks that you want to own, that you believe in any market condition, when you're in the market that way, guys, you don't lose. Because if the market drops, you get to buy stocks at good value. If the market goes up, what you currently own is going up in value. We're long-term investors, okay? When you're a long-term investor, you you don't lose when you invest in high quality stocks. I know there are a lot of people that teach a variety of different strategies, and I'm not going to criticize anybody for what they teach. But I can tell you this, when you're a long-term investor, you don't lose. If you go back and to the beginning of the stock market, if you put money in the stock market at any point in history, if you held on to those investments for 5 years, you made money. At any point in time, if you invested in the stock market and you held on to those investments, and it was a good investment, okay? Like not, some of y'all be doing some different stuff, like, penny stocks, and I'm not talking about that. Buying only IPO, I'm not talking about that. I'm talking about when you buy high quality stocks. When you do that and you hold on to them for a 5-year period, you made money. The problem with some of the short-term strategies that people are using right now, it's like you win sometimes and you lose sometimes. And those, you realize those losses. See, when you invest in the stock market and the value of your investment goes down, but you don't sell, that's an unrealized loss. So you still have the opportunity for your investment to come back, and a loss can turn into a win. But with some of these short-term strategies that people are using, when you lose on those and you cut your losses or you get stopped out, that's a real loss. So when you play a game where you're up one day, you're down one day, you're up one week, you're down one week, you're up one month, you're down one month, you up and down. And very rarely do people come out and turn a profit. But when you invest in high quality companies and you hold for the long term, you're gonna win. You're gonna make money. History shows it. That's the reason why I teach beginners to not get caught up in chasing higher returns. Because when you chase high returns, you're gonna also experience high losses. When you chase high returns, you're taking more risk. And there's always risk when you invest in the stock market. There's always risk. But when you invest in high quality companies for the long term, that's less risk. So one of the things that we will talk about during the free class is, what is a high quality company? Because I know somebody has the question. It's like, okay, you're saying high quality, you're qualifying it. Well, what's a high quality company? I'm going to teach you what a high quality company is on the free class. So make sure you join. The link is in the description. Today is Sunday, so I'm recording this video on a Sunday. So we're going to meet at 4 p.m. Eastern Standard. I also do the free beginners class on Thursdays at 8 p.m. So whenever you're watching this video, you have 2 times a week where you can catch our free class. And so we're going to be focused on this conversation around how we need to prepare during a down market. Okay, we're going to be having this conversation. We're going to be having this conversation consistently, probably for the next couple of weeks, maybe even longer. because like I said it a moment ago, I think we continue to go lower. I think the stock market continues to go lower for the rest of the year. I think we open up the new year, and I think the market is still going to be pushing lower. Because of that, I want to make sure that my audience is prepared emotionally and strategically. Okay, I want to make sure that you all are prepared emotionally and strategically for this potential downturn in the market. Now, look, I could be wrong. This just may be a temporary pullback that we're experiencing right now. This could be a temporary pullback, and then maybe the market goes higher even before the year. Maybe we get, we start looking at some of the spending that's taking place during the holidays, and maybe spending is up this year compared to last year. Right? Maybe spending exceeds the analyst expectations. That's going to be really good for the stock market. Okay, so I could be wrong, but number one, I don't think spending is going to exceed analyst expectations. There are fewer jobs. People are making less money. There are more layoffs. Consumer sentiment is down. People are worried. People aren't buying houses. Housing is expensive. Incomes aren't going up. The Federal Reserve is saying they're not going to cut interest rates. Inflation is up. I could go on and on and on about all of the different reasons why I think the market will continue to push lower. Okay, but even with all of those reasons, I could be wrong. Okay, even with all of those reasons, I could be wrong. Um, and if I'm wrong, it's okay, because again, when you invest consistently, if the market is up, you benefit because you have money that's invested. If the market is down, you benefit because you can buy high quality companies at a discount. The market will go down through your time as an investor. So you have to be prepared for that and have a strategy that you can use during those times. Um, in terms of historical context, bear markets last 8 to 10 months, so just almost a year. Okay, but bull markets last 2.5 years, almost 3 years. So even when the market is down, even when the market is at its worst, so a bear market, when there's a bear market, that means the stock market has dropped more than 20%. Okay, more than 20%. So that's really, really frightening. But you just have to be patient and continue to invest, because when we hit the bull market again, it's going to last for 2.5 years. Here's the last point I want to make. And you guys make sure you go to the link in the description to register for the class. The best days in the stock market happen immediately following the worst days. And if you miss those best days in the market, that can greatly impact the performance of your portfolio. To the tune of as much as 50%. So if your money isn't invested during the best days in the stock market, you could hurt the performance of your portfolio by as much as 50%. So it behooves you to stay invested during the bad days. Don't sell when you see the market turning around, especially if you own high quality stocks. Be patient, buy more, and it's going to come back. All right, guys, that's what I wanted to share this morning. I'm going to go home, get ready for the day. You guys make sure you register for the free investing class. If you're a beginner, I'm going to teach you the basics in this class as well. So we're not just going to jump straight to how to invest during the down market. I don't do that. We set the expectation, we set the foundation, what's a stock, what's a mutual fund, how you make money. I talked a lot about high quality stocks. I'm going to give you all what my definition for a high quality stock is. This is what I look for when I invest in the stock market. I'm going to share that with you. I'm going to talk to you about how you need to be investing on a consistent basis, how much to invest, in different scenarios. So even if you're a complete beginner, I'm going to give you all of that. I'm going to tell you how to actually invest, what you need. We're going to talk about getting a digital broker, setting up your account with the digital broker, putting money in there. Um, I'm going to give you some stocks that you can start investing with as a beginner. I'm going to give you all of that because my goal with these beginners classes that I do these twice a week, guys, Sundays and Thursdays. My goal is that I can take an absolute beginner who can sit through this class, and by the next day that the market opens, you are ready to invest. So there's no procrastination, there's no hoping, no wishing, no uncertainty. I literally you'll sit through this class, and by the next market day, you will be ready to invest. Because what I do is about action. Okay, this is about action. This is about starting. This is about taking advantage of time and being consistent. So that's what we're going to do. The link is in the bio, guys. I will see you all hopefully today at 4 p.m. Eastern Standard. And if not today, I hope to catch you in one of the Thursday classes. But don't be afraid of what's happening right now in the market. This is a great opportunity for us, and we're going to take advantage. All right, guys, I'll see you all in the next video.